Welcome back to the deep dive. Our mission today is, well, it's to cut through all the noise in the financial markets. We want to laser focus on hard assets.
Right. Specifically gold and silver.
Exactly. Because as of September 2025, the investment sources we've looked at are pretty insistent. They're saying the landscape has hit a real critical inflection point. We're talking about a data-driven strategic case, a reason maybe to allocate capital right now.
That is the consensus, yeah. But it's important, I think, to understand why this isn't just, another short-term trade.
Okay.
Our sources. They describe this as more of a structural shift. It's driven by a, let's say, rare and powerful confluence of macroeconomic forces. So we're going to give you the shortcut to the data. We'll focus on basically the four primary trends that seem to have fundamentally altered the risk-reward picture for precious metals.
Okay, let's unpack this then. Let's start with the ultimate catalyst. What actually shifted us from that world of tightening monetary policy to where we are now?
That pivot, yeah, that's the core of the whole thesis. The Federal Reserve's dovish turn. Back in September 2025, the FOMC, that's the Federal Open Market Committee, they initiated their first interest rate cut of the year.
Right.
It was a 25 basis point reduction, brought the target range down to 4.00% to 4.25%.
So, okay, after the longest rate hike cycle we've seen in a while, we've officially moved into easing territory. But one cut doesn't necessarily signal a trend, does it?
No, not on its own. It's the forward guidance that really matters here. The Fed's latest dot plot.
Which is their forecast for future rates, right?
Exactly. It's their collective forecast. And it signals potentially 2 more 25 basis point cuts before the end of this year, 2025.
2 more? Wow.
And they're forecasting an additional 50 basis points of easing for 2026. So this kind of aggressive front-loaded easing, it just reduces the opportunity cost of holding non-yielding assets. Things like gold and silver look better relative to, say, bonds or just holding cash.
Okay, this all sounds pretty bullish for gold, obviously. But the Fed doesn't usually cut rates unless something is, genuinely broken or looks like it might break. What's the justification they're giving for such a rapid shift?
That's the second factor. A rapidly deteriorating U.S. labor market, job growth, it's slowed dramatically. The August 2025 non-farm payrolls, they added a meager 22,000 jobs.
22,000. That's barely keeping pace with population growth. The economy isn't really creating new jobs at that rate.
Exactly right. And what makes that number look even worse are the revisions. Prior months were revised down, significantly down, including June 2025, which was revised to a net loss of 13,000 jobs.
A net loss back in June. Okay, that's a major signal. It tells you the weakness isn't just recent. It's kind of systemic, perhaps.
It looks that way. The unemployment rate is now sitting at a 4-year high of 4.3%. But here's the statistic, the really alarming one, that likely justified Powell's dovish shift. For the first time in 4 years, the number of unemployed people now actually exceeds the number of available job openings.
Wow. Okay, unemployed exceeds openings.
Yeah, and on top of that, the long-term unemployed, these are people jobless for 27 weeks or more, that's climbed to a post-pandemic high of 1.9 million. So Powell, he framed the rate cut as more of a risk management measure because the threat of recession, it seems, now outweighs those inflation concerns.
Wait, unemployed exceeds job openings? That is the classic, almost textbook definition of the labor market having fully rolled over. So the takeaway from the labor data is basically fear of recession is now dominating policy.
That seems to be the case.
But what makes this environment truly unique, or maybe paradoxical, is that the inflation threat hasn't just vanished, right? Let's talk about that paradox for a second.
Right. That brings us neatly to factor 3, the inflation paradox and real interest rates. Despite the slowdown, inflation is proving sticky. The Fed's own projections, they forecast core PCE inflation.
Their preferred measure.
Yeah, their preferred underlying measure. They see it at 3.1% in 2025. And they even project it will stay above their 2% target, landing at 2.6% in 2026.
So, okay, if the nominal interest rate is dropping fast down to, about 4.125% in the middle of the range, but inflation is stuck up at 3.1%, then you've got low real interest rates.
Precisely. That's the key. The driver for gold is the real interest rate, nominal rate minus inflation.
Right.
With rates falling and inflation sort of stubbornly persistent, real rates are low. And they look poised to fall even further, maybe even into negative territory down the line. This scenario, slowing growth plus persistent inflation, it's what we might call a stagflation-like backdrop.
Stagflation's late, okay.
And that kind of environment historically creates a multi-year tailwind for hard assets, things that protect against both currency debasement and economic distress.
I get the theory, but I have to play devil's advocate a bit here. If the economy is slowing down, recession signals flashing. Shouldn't we expect a market crash? Yet, the S&P 500 is trading near all-time highs. How is gold supposed to perform if the stock market just keeps ignoring the slowdown?
Yeah, that's a fair point. And it leads to the fourth mutually reinforcing trend, record high equities and the, let's say, heightened need for diversification. Yes, the S&P 500 is elevated, which logically means the risk of a significant correction, a market sort of repricing reality, is substantial.
Okay.
And historically, gold is just the ideal non-correlated asset to own when the stock market does correct.
Do we actually have the data to back up that non-correlation claim? Because people say it all the time.
We do, absolutely. The sources we looked at noted that since 1971, there have been 9 years when the S&P 500 posted negative returns.
9 years, okay.
Gold outperformed the S&P in 8 of those 9 years.
8 out of 9, that's pretty compelling.
It is. In those down years for stocks, gold delivered an average return of 19.4%. Compare that to the S&P 500's average loss of 15.3% in those same years.
Big difference.
Huge difference. And what also reinforced this now is the global appeal. There's widespread economic softness abroad, particularly, China, the EU.
Right.
And that's driving central banks to purchase an estimated, get this, 900 tons of gold in 2025 alone, just for reserve diversification.
900 tons. That's massive institutional demand. Okay, that sets the macro stage perfectly, I think. So now let's drill down into the metals themselves. Yeah. Gold and silver, people often lump them together, but they really have two distinct investment cases, right? Rooted in that macro environment. Let's start with gold.
The stability play.
Right. Gold is, well, it's the monetary metal. It's the portfolio anchor. Spot gold is currently near its all-time high, trading around $3,685 an ounce.
Wow.
That represents a year-to-date gain of roughly 38% to 42%. So the strategic advice we're seeing is pretty firm. Buy the dips. It reflects some profound institutional confidence. The source has definitely noted a strong institutional consensus, mentioning big names. JP Morgan, Goldman Sachs, forecasting a price target of $4,000 per ounce by mid-2026. That sounds incredibly optimistic, though. What specific risk are those forecasts maybe not factoring in? Is it just market hype?
Well, it's easy to see it as hype, but it seems driven by two pretty structural demand trends that are fundamentally inelastic. First, that huge demand from central banks we just mentioned. That's driven by devalorization efforts, wanting to diversify reserves. That creates a powerful sort of permanent floor under the price.
Okay, inelastic demand there.
And second, there's renewed institutional interest. We see ETF holdings at their highest level since way back in November 2022. Institutions aren't just betting on a tactical rally. They seem to view gold as a necessary core holding because of those falling real rates.
Oh.
So that $4,000 target, it seems predicated on ongoing systemic risk and that monetary easing continuing, not just short-term market sentiment.
Got it. That makes the case for gold as your sort of portfolio insurance policy very clear. Now, silver. It's often called gold's high beta cousin. How does its investment case differ from the stability play we just discussed for gold?
Yeah, silver is definitely the high beta growth engine, if you will. It's significantly more volatile. Daily price movements can often be 2, even 3 times greater than gold's.
2 to 3 times, okay.
And it has actually slightly outperformed gold this year. It surged past $42 an ounce, giving it a YTD gain of approximately 43%.
That volatility, that's where the gold to silver ratio comes in, isn't it?
Yeah.
If the ratio is high, it suggests silver is historically cheap relative to gold.
Exactly right. The ratio currently stands quite high at 87.59 to 1. That's very elevated compared to its long-term historical average, which is more like 60 or 70 to 1.
Right.
So a high ratio like this suggests silver is, relatively speaking, undervalued compared to gold. It positions it for potential mean reversion. If this whole precious metals bull thesis continues, silver should appreciate faster than gold until that ratio corrects closer to its average.
And the key unique factor for silver, the thing that really sets it apart, is its powerful industrial demand component, right?
Yes, absolutely. That is the core of its sort of dual demand thesis. Silver benefits from all the same monetary tailwinds as gold, plus industrial demand accounts for over half of its total consumption.
For half. Wow.
Yeah, and it's critical for these long-term, policy-driven structural trends like the global energy transition. It's essential for solar panels. It's about 16% of demand right now, and it's growing about 14% annually.
Huge growth there.
And it's also vital for electric vehicles.
So, okay, here's that critical contradiction or maybe unique feature the sources highlight. Unlike other industrial metals, say copper, which usually falls off a cliff when the economy slows,
Right.
silver has this kind of safety net from the Fed easing, plus the inherent resilience from that policy-driven demand in green technology.
Precisely. That dual nature means its industrial demand is far more resilient than it would be during a typical recession. It benefits both from the cause of the slowdown, which is prompting the Fed easing, and the structural solution to energy problems, which is driving that technological demand. It creates a uniquely asymmetric risk profile for silver.
Okay, let's move to the practical side then. Strategic allocation and implementation. We've established the why, the macro picture, and the what gold for stability, silver for growth. Now the big questions. How much capital should you actually commit, and what kind of investment vehicle should you use?
Okay. The consensus allocation for precious metals coming from strategists generally suggests somewhere in the range of 5% to 15% of a total diversified portfolio.
5 to 15%.
However, given the sort of confluence of systemic risks we've outlined, the stagflation, light environment, high equity valuations, some experts are suggesting pushing that allocation higher, perhaps even up to 20%, maybe 25% in some cases.
25%. That sounds pretty aggressive for a non-yielding asset.
Yeah.
So if a listener is, say, highly risk-averse, focused on preservation, how does that allocation framework change for them?
Yeah, it definitely depends heavily on your individual profile and your time horizon. For a, let's say, conservative investor focused primarily on capital preservation, we might look at an 8% to 12% total allocation, but weighted heavily toward gold, maybe something like 70% gold, 30% silver.
Okay, gold heavy for conservative.
Right. But for the more aggressive investor, someone with a long time horizon who's comfortable with that volatility we talked about, they might target 15% to 20% total, but they'd weight it heavily towards silver, perhaps 30% gold, 70% silver, to try and capture that high beta leverage, that potential outperformance.
That makes the what type question absolutely crucial then. Physical bullion versus the liquid ETFs. This isn't just about preference, is it? It's a strategic decision.
It absolutely is. It's fundamental. Physical bullion, we're talking coins and bars you hold yourself, or an allocated storage, provides true ownership and, critically, zero counterparty risk.
Zero.
This makes it the superior instrument if your main goal is hedging against systemic financial failure. It's essentially a bet against the stability of the financial system itself.
Right. But there are drawbacks.
Oh, yeah. Storage costs or risks, definitely. Lower liquidity compared to ETFs, and usually higher transaction premiums when you buy or sell.
Okay. And the ETFs, things like GLD for gold, SLV for silver, they serve a different purpose entirely.
Yes, completely different. ETFs offer just unparalleled liquidity and convenience. You can buy and sell them instantly through your brokerage account. They are essentially a bet on the price of the metal, but conducted within the established financial system. Perfect for tactical trading or adjusting exposure quickly.
But they have their own risks.
They do. They introduce custodial risk. You don't own the metal directly. You own a share in a trust that supposedly holds the metal. And they come with an annual expense ratio drag. GLD is about 0.40%. SLV is 0.50% per year. That eats into returns over time.
So given those trade-offs, what's the superior strategic approach? If an investor wants both that insurance aspect and some growth potential.
The sources seem to converge on what you could call a barbell strategy. Seems like a really smart approach.
But barbell, how does that work?
You use physical gold as, say, a 10% core defensive anchor in your portfolio. That's your pure systemic insurance component. Then you use silver ETFs for maybe a 0% to 5% tactical growth engine sleeve.
Ah, I see. Physical gold core, silver ETF tactical.
Exactly. It perfectly aligns the investment vehicle to the specific goal: preservation via physical ownership and opportunistic liquid growth exposure via ETFs.
Okay, final implementation question then. Timing. Should we try to time the market and invest a lump sum, or should we be using dollar cost averaging, DCA?
Right. Well, statistically, lump sum investing can sometimes outperform in a clear bull market if you get the timing right, but DCA is incredibly powerful behaviorally.
How so?
It mitigates that timing regret, the fear of buying at the top, and it enforces discipline. You just keep buying regularly. For stacking physical bullion, DCA is highly recommended. It helps smooth out those dealer premiums and the spot price volatility over time.
Okay, so it helps with physical premiums.
Yeah.
But is there a purely mathematical reason to use DCA, especially thinking about silver's volatility?
Yes, there is, and it's particularly critical for silver. Because silver is so volatile, that high beta characteristic we keep mentioning, it suffers from something called volatility drag.
Volatility drag.
Yeah. By consistently investing a fixed dollar amount, DCA mathematically ensures you purchase more ounces when the price is low and fewer ounces when the price is high. This process actually lowers your average cost per ounce over time, making DCA a really sound technique for managing silver's inherent price swings.
So essentially, because silver swings around so much, using DCA isn't just about discipline, it's mathematically advantageous to avoid accidentally buying all your ounces near a peak. It's a huge takeaway, actually.
It really is, especially for silver investors.
Okay, so to try and summarize this entire deep dive then, we have a dovish Fed, we have a deteriorating labor market, and the result is low, likely falling, real interest rates. All this creates an exceptionally strong structural case for a strategic allocation to precious metals right now. We're talking targeting somewhere in that 5% to maybe 20% range of a portfolio.
That's the core takeaway, yes. Now, just briefly, we should consider the headwinds. The risks.
Right, always important.
The primary risk, the big one, remains a hawkish surprise from the Fed. If inflation were to suddenly reaccelerate, forcing them to reverse course and hike rates again, that would lead to much higher real rates and likely hurt gold and silver badly.
Okay, Fed U-turn is risk number one.
Other risks. Well, a surprisingly strong, sustained economic rebound could undermine the safe haven thesis, or just a continued, powerful equity market rally that keeps diverting capital away from hard assets.
Got it. So our recommendation remains, use a buy-the-dips approach within that strategic allocation range, 5 to 20%, and really focus on that blended barbell strategy, physical bullion for the core insurance, and liquid ETFs for the tactical price exposure, especially with silver.
Exactly. And maybe here's a final provocative thought for you to consider as we wrap up. The major buyer of gold seems to be fundamentally changing. The primary demand driver is shifting away from, say, volatile retail flows or Western institutional tactical plays, and moving towards long-term strategic allocators. We're talking global central banks, sovereign wealth funds focused on de-dollarization, focused on permanent wealth preservation.
A structural shift in the buyer base.
Yes. So the question becomes, if the world's most sophisticated financial institutions are fundamentally changing how they view gold, moving it from just a temporary safe haven to a permanent strategic core holding, what should that imply about the permanence maybe of your own portfolio allocation to it?
A very interesting question to leave our listeners with, something to definitely mull over.